Hey, thanks for tuning into today's video. This video is going to be about PE ratios. And you may have heard of PE ratios in the stock market. They're really popular for measuring kind of the valuation of a company. And so I'm going to give you some examples of PE ratios and how to use them and some of the shortcomings of them. And so let's get into it. So when we talk about the PE ratio, you'll see it written as P/E, and we'll talk about what these are. So in the PE ratio, the P stands for price, and the E stands for earnings. And so the price is referring to the price of the company. So that would be the market cap. And that's just the valuation of the entire company. So it's the number of shares times the share price. And that would give you the market cap. So that's the price of the entire company again. And then that's divided by E, which is the earnings. And the earnings refer to the last year of net income for that company. And so if you did this calculation, it would give you a certain number, and that number would be your PE ratio. Now let's look at a really basic example of a small business. And let's say that you're running a lemonade stand and you've made, let's say, $1 million in net income last year. So that would be your E, your earnings. And so it's a pretty big lemonade stand. And then you may be thinking, well, how much would I accept to sell this business? Well, let's say an investor comes by and offers you $13 million to buy the entire business. Now that poses kind of a tricky question for you as the owner of this business, because you could either take your $13 million right now and be gone, or you could take your chances that you keep earning $1 million a year, or you may even earn $1.5 or $2 million a year far off into the future. And that's sort of the risk that you're taking, but the reward would be, earning more than $13 million versus just taking the investor's offer of $13 million. So, this offer would give you a PE ratio of 13 times. And you have to kind of determine, is that fair or not, based on, your lemonade stand's growth and the competition and your profit margins and things like that. And so that's basically how a PE ratio works in a nutshell. And in the real world, not all companies have earnings in the stock market. Some of them just have revenue that's growing really fast, but they haven't earned any profit yet, so they wouldn't have a PE ratio. But that doesn't necessarily mean that it's a good or bad investment. You have to just look at a lot of different factors that go into the investment analysis for this company. And some PE ratios will be really high, some will be really low, and you just kind of have to figure out why, and is that a fair valuation. All right, let's look at a really simplified example from an investor's perspective so we can get a little bit better sense of how to use the PE ratio. So let's say I give you two choices and you have to buy one of these stocks. And I give you company A, and it has a PE ratio of 17 times. And then I give you company B, and company B is less highly valued, and it has a PE ratio of 5 times. And so which one of these would you rather buy? And you might have said company B because it has the lower PE ratio, but this is kind of a trick question because you don't really have enough information. And that's kind of the point is, as an investor, a PE ratio is good to look at, but it's not the end all be all. And you have to look at other factors like growth and things like that to kind of form an educated and informed investment decision. Now, if company A and company B were exactly the same company, yeah, you would rather have company B at the lower valuation because that's going to give you, less downside and potentially more upside. Now let's look at a couple real world examples of real companies in the stock market so we can get a better sense of how the PE ratio is calculated and sort of how to make sense of it. So the first one we're going to look at is Google. And so the price or the market cap for Google at the time of this recording is 1.48 trillion. And the earnings from the last 12 months for Google is about 75 billion. So if you divide 1.48 trillion by 75 billion, you would get 19.7 times. So that's your PE ratio, 19.7. And so how do you make sense of that? So like I mentioned earlier, there are a lot of other factors that go into a PE ratio, and one of them is growth. And so looking at this example, Google had a year-over-year earnings growth of 45%. So that's pretty high. And usually the stock market as a whole will have a PE ratio anywhere between like 15 and about 23. And so you may be thinking, well, Google, as a huge company with almost no competitors and pretty good growth, should probably have a higher PE ratio than the market itself. And that's a pretty good idea. But there's a lot of other factors to look at. Okay, so the next real world example we'll look at is Tesla. And Tesla is an interesting one because they're growing very fast. And so the market cap for Tesla right now is 749 billion. That's what all of Tesla is worth if you wanted to buy it. And the earnings of Tesla in the last year is 8.4 billion. So if you divide those two, you would get 89.2 times earnings. And so that's a lot higher than the 19.7 that Google had. And so you may be thinking, well, that's a bad investment. Well, you have to look at the other factors, like I said. So in the case of Tesla, it had 635% year-over-year earnings growth. So that's a lot higher growth than Google's 45%. So it doesn't mean that they're a good or bad investment just based on this as well, because the growth was, in the past, and you have to look at the growth for the future as well. But you can kind of see why Tesla has a higher PE ratio than Google because it's grown a lot faster. And so you'd be willing to pay more for the earnings this year because it's, reasonable to expect that Tesla would grow earnings really fast in the future. So that's how it's calculated and how you kind of have to think about it as an investor. And, if you're looking at this example, Google versus Tesla, that's a pretty tough decision to have to make if you could only buy one. And that's what investors have to kind of wrestle with every day. And that's why the stock market isn't a straight line. It looks like this all the time because investors with different opinions are wrestling over the valuations of these big companies. And every minute of every day that the stock market is open, they're buying and selling based on the changing valuations of these companies. So that's what you have to deal with as an investor. But if you sort of figure out and find where some companies are undervalued and where you might want to avoid where they're overvalued, if you can figure that out, it's extremely rewarding and can make you incredibly wealthy if you are disciplined and you're able to, judge that in the right way. So to kind of sum up today's video, PE ratio is about valuation. It basically gives you how much you're paying for this year's earnings for a company, and higher PE ratio means it's more expensive compared to this year's earnings. Lower means it's less expensive compared to this year's earnings. And that's based on a number of factors, but you can't just look at PE ratio alone. It's not the only important factor to look at when you're investing. There's growth, there's competition, there's profit margins, future expectations, macroeconomic factors. There's all these different things that go into the PE ratio, and then the investment analysis itself. So you want to make sure as an investor that not only are you considering the PE ratio, but you're also considering all the other factors that go into this company's profile. So I'll leave you with that. I hope you got smarter today by watching this video. And if you have any questions about this stuff, just leave it in the comment section below, and I'd be happy to answer it. And I'll see you in the next video.